I have the honor today to have Nick Maggiulli, the great Nick Maggiulli, Nick Numbers, here on my show. So, Nick, you are Chief Operating Officer at Rituals Wealth Management. You guys, I love you guys all. I mean, I've been a huge follower of you, Ben, Michael, Josh, Barry, and whatnot. So, thank you for being here.
Of course, anytime. Thank you for having me, Giorgio.
Okay, so first of all, a huge disclaimer with you, Nick. I think I've read probably like something like 90% of all your posts, something like this. And I find myself usually nodding, oh, wow, that's amazing, that's insightful. But you're also one of those, probably the personal finance, content creator, sorry for that, that name, with whom I find myself sometimes not aligned with. So I say, well, no, this is not true. It's still insightful, but not exactly true. So please don't, in the second part of this interview, I'm going to challenge some of the things you've written, but keep in mind that just maybe it's like 5% of things I disagree with. The rest I totally with you. So let's get into that. You're not just a personal finance, a financial assistant. What's your actual job title? Can you define a bit?
So I'm not an advisor. I'm the chief operating officer. So all the stuff I do is I'm helping us scale the organization and the business to allow more operations to be done more efficiently. So I run the trading team. I do billing our clients.
Okay.
I help with all the CRM stuff, which is the customer relationship management system. So how when we're talking with clients, we're recording the notes. We have their name. We have all their information about all the history we've had, all the money we've moved for them, etc. So anything related to the relationship, recording information related to the relationship, servicing the relationship, help with that. And I try and do it using data and a lot of other things. So I came in as a data scientist, and I just ended up doing so many different things for the firm that I was promoted to COO in 2020. So I've been doing that ever since. So help scale the firm. Yeah, we started with under $1 billion. When I first joined, we had 800 million, and now we're over $7 billion. So it's the firm is almost 10x since I've joined. So it's been quite a journey, and it's been fun to see it happen. But yeah, it's been very interesting overall.
Okay, so you're not in charge of one-to-one relationship with customers and things like that. Okay, but apart from that, you're also a writer. You have your own blog of Dollars and Data that probably it got this job. It got you this job, and you also wrote a couple of books. So the Wealth Ladder and Just Keep Buying, which I have the Italian version here, published by Utili recently. And can you tell us what's the rationale behind those two books? Why did you write Just Keep Buying, and what did you want to tell the world? And the same for the Wealth Ladder.
Yeah, so I wrote Just Keep Buying really because of COVID. I was in a spot where like the world had shut down, and I was like, oh, we're going to be trapped inside forever. I need to use this time. This is an opportunity for me. At that point, I had been writing for over 4 years at that point. So I started in early 2017. And so by then it was 2021. And I was like, hey, I have 4 years of material I can use. Let me see if I can put together like kind of my summary of my beliefs on personal finance and investing. And that became Just Keep Buying, right? The book's split into two parts. There's the saving portion in the first half, which is all like the individual personal finance stuff. And then there's the investing portion in the second half. And I broke it into those two sections because I think that's kind of how the journey for most people goes. Like they start out, they need to save money, they have income, right? They're focusing on those things, getting just some sort of wealth accumulated. And then later, they need to allocate that wealth in a way so that it keeps growing, right? And that's where kind of the investing piece comes in. So that's kind of how the first book came about. The second book came about because it is Just Keep Buying it is still a very limited framework. It's like a one strategy. It says, hey, everyone should just do this. And I think it's a great strategy, and it's one of the ones I recommend for most people if I know nothing about you. But there were some people I was missing, right? There were people who were extremely poor who just don't even have the assets or anything even to get started. And so some of the early chapters of Just Keep Buying cover them, but it was overall like telling people just to buy income producing assets isn't the solution for them. And there was those people who said, well, Nick, a 9-to-5 job plus, investing in the stock market's not going to make me rich, because their definition of rich was much, much higher, right? So I realized I was like kind of missing those people. So I said, you know what? I need to come up with a new framework for understanding wealth across the spectrum, right? And so what I called was the Wealth Ladder, which is a term that's been used a very long time. I don't even know when it was first used, but I just defined it. And I said, hey, the Wealth Ladder, there's these different levels, and depending on which level you're in, determines kind of what strategy you might follow, how, if you want to get to a different level, what you might do differently than someone lower or higher up the wealth ladder. And so I just really said, hey, let's think about this more as instead of a one-size-fits-all solution, like just do this, just keep buying. Instead of just doing that, let's say, hey, where are you now? Where do you want to go? And then here are the strategies available to get there.
So it's more generalizing for a different starting situation, while
Exactly.
just buying is like the regular path, but you might be in a different position during this path.
Exactly.
I also started the blog more or less when you started your blog. So what's the role of writing in your career so far? And what's the plan for the future? Do you plan to become a regular writer, like a book writer, or whatnot? Can you tell me a bit about this?
This is a great question. I think for my career, it's still very open-ended because I do write regularly on the blog. I write once a week, and I've been doing that for almost 9 years now. And I do that because it really clarifies my thinking. Like there's a lot of times where I'm like, oh, I think this makes a ton of sense. And then you go to write it and it doesn't, or doesn't come out the way I want. And then I realize my thinking's not as clear as I thought. And so I have to really, really go and work on these arguments to make them clearer and to make them better, basically. And so that's how I look at the role of writing. It just clarifies my thinking. Does that mean I'm going to be a book writer forever? I don't know. I love the first 2 books I've written. I don't have a third idea. I don't have like, oh, this, is what I want to write about. There are some smaller ideas I could write about. I'm not sure if I could turn them into a book. I need to think about that a little bit more, but we will see where the world takes me, kind of what things come up, how the world evolves. I think that's another big question of like what's going to happen with wealth, what's going to happen with US debt, with asset class, with asset prices, with economic classes in the United States and around the world. Like all these questions are up in the air, inflation, all these things, because we don't know the future. As the future starts to unfold and these kind of mysteries become solved, I think that's going to help me figure out where the next path is.
I mean, given the title and the content of the first 2 books, you aim to write about things which are evergreen. So I don't know if that's true for you, or I mean, the current situation, how the world could which direction it could go, might be something which is just temporary. I don't know. What are the big lessons that are valid forever that we can learn from current situation? But anyway, I'm looking forward to actually looking forward to the second book, because I only have the first one, so I will need to buy your second book. Anyway, we're gonna walk through your books and just see. I have a lot of questions about both the wealth ladder and just keep buying. Let's start from just keep buying. Why do you think that we invest? What are the reasons why we regular people invest?
So the main reason, I guess there's probably 3 main reasons why people do it, but the one that I think is the most relevant one is that at some point, like, we're not going to have any income to support ourselves. And so, yes, governments can help with that. There's, in the United States, we have Social Security. I know there's pension systems in Europe, around the world, right? But the idea is to have some extra money just in case, you can support yourself. You can have a place to live. You can, have food, all that type of stuff. And that is really a function of longevity and life expectancy, right? This wasn't true. You go back 100 or so years and people weren't living as long. I mean, 100 years is about right, but let's go back 200 years. People weren't living as long as they are today. And as a result of that, because people are living longer, they need to have something to support themselves, right? They need to have some sort of financial resources that they didn't necessarily need a few hundred years ago when people didn't live till in their 80s, 90s, etc., right? So, or at least not as often. So because of that, I think that's one of the big reasons. The other one's inflation. I'm coming from a stance that inflation is a normal thing. It will continue to happen. The US dollar will degrade in terms of its purchasing power. So by investing, you offset that, right? And over the long period, even during some of the worst periods in U.S. market history, someone who had been buying over time would have even kept pace with inflation. I know the U.S. is exceptional in this, right? But still, if you have a diversified portfolio and you own that over time, it's going to keep pace with inflation, or it has, at least historically. I'm not saying that's going to be true forever. It would be a shock if that didn't happen in the future, but over long periods of time, owning a wide, basket of equities, world equities, has kept pace and actually surpassed inflation. So you're actually growing your purchasing power, not just keeping pace, right? So the worst case scenario, I assume, is you just keep pace with inflation, which I think is still great. You're putting money somewhere and it's going to be worth something. Now, if you take $1 and bury it and come back, 50 years, it's not worth as much, right? So I think that's kind of the next big reason why it happens. Those two, inflation and then kind of replacing your human capital with like this
essentially
financial
sooner
assets.
or later financial independence. I mean, at
Yeah,
one point
those
you
two
need
are
to
the big
be-
ones for me.
Okay. Do you think it's just I like to challenge also the status quo and what we give for granted. Do you think life expectancy will keep raising?
I guess it's a good question. I think we're hitting limits to it. I think there are things you can do to extend it, but I don't know how much further it can go. Trust me, I know like, well, science and all this and anything is possible. Trust me, I of course it's possible, but I think at some point there is a limiting factor that we just don't know enough about, and I don't know if we're going to be able to reverse that, right? The telomeres on the end of our DNA or whatever that are just causing us to age. I think it's very, very difficult to quote.
Sorry, I still have some.
I think it's
from my flu.
I think it's very difficult to quote play God and just say, yeah, we're going to live forever. I think that's not going to happen.
I actually think that maybe I don't know. I think about my parents. I mean, at least in Europe. We have been, I don't know, 30, 40, 50 years of something like surfing the wealth bandwagon. So with people with fixed pension benefits, with like jobs that weren't that difficult. So I see at my parents, for example, my father retired at 55 and now he's watching TV all the time. He had a pretty relaxed life compared to maybe my generation or even the generation after. I'm 48, just for reference. So I actually think that maybe we are more stressed. We are less time to relax. Kids are more demanding. So I actually sometimes think that it's not guaranteed that the average life expectancy will go up. Of course, from a medical point of view, we are improving. Maybe we will reach a barrier. But maybe from an actual point of view, we will not be that relaxed. So that, but I mean, that's just speculation. Okay, so what I heard is that we essentially invest to keep up with inflation, at least beat inflation, or at least make your wealth survive after inflation. And maybe one day you will be able to live off what you saved, or partially or totally, depends if you have some support in terms of pension scheme or whatnot. What should we invest in? What are the things that make an investment?
This is a very generalized answer, but the answer is income producing assets. And the reason for that, you can't just pick any one asset, because I've seen just too many people get rich in very different ways. I've seen people do it with real estate. I've seen people do it with owning a business. I've seen people do it in stocks, obviously, right? Theory, you could do it in bonds, 100% bonds, but you'd have to just have a really, really high income. I don't recommend that because of the inflation stuff. They usually don't keep pace with inflation over very long periods of time. There are short periods of time where bonds can keep pace with inflation, but generally that's not true. So I say income producing assets more generally, but you have to have some, there's probably more of a tilt towards risk assets. So that's, things that can go down in value, things that can lose money, businesses that can fail, and just owning a diverse basket of those, right? That is kind of the key. Over history, that would have worked very well if you owned a diverse basket of income producing assets, and I believe that's going to continue to work in the future. And diversification is the most important point, because we don't know what's going to happen, right? We had no idea that AI was going to take off like it did. We didn't even know what AI was, 5 years ago. So I think as we kind of learn more about the world, as new inventions get created, all this type of stuff happens, you kind of need to own a little bit of everything and then just let the chips fall where they may.
You said a little bit of everything, but you also say the income generating assets. I'm pretty aware of a lot of assets that people are investing in latest years, which are not by definition income generated, like crypto or gold or collectibles. Do you have any opinion on this kind of assets?
Yeah, I own some as well, but it's, less than 10% of my portfolio. I say up to 15%. So I say 85% of your assets should be income producing, and you can go up to 15% should be non-income producing. And I've kept that. Actually, mine is, I think I have 5% is non-income producing and the other 95% is income producing. But it's varied over time. At one point I was 90% income producing, but I think it should be a minority of your portfolio.
What's the rationale? Yeah.
The rationale there is that there is no the value of gold, the value of Bitcoin, etc. Those are all based on what other people are willing to pay for them. The same idea is true with income producing assets, right? Someone has to pay for, if I'm not willing to pay for Nvidia, the price goes down, right? If no one's willing to pay for it, it goes down. But the difference is like, imagine a suitcase, right, with money inside of it, right? An income producing asset has some fundamental, there's money inside the suitcase. Maybe people might not think there's as much money or less, but there's something in there. With gold or Bitcoin or something else, there's no money in the suitcase. We're all just passing the suitcase, assuming that someone thinks there's something in there.
Amazing metaphor. Yeah.
But, so that's what I'm saying. There's some weight. There's some like kind of level of like, there's at least 50 grand in this suitcase. So like maybe temporarily people won't believe in suitcases will go below 50, but it shouldn't deviate that much from the fundamental value of the thing. With gold, Bitcoin, or wine or art, it's harder to know that in the future. And that's where I'm kind of a little hesitant. So I think you should own them as a diversifying asset class, but I don't think it should be the bulk of your assets.
So the reason for owning, the rationale for owning non-income producing assets is for extra diversification, or for like decorrelation or something. You should base your decision on like back test, or just gut feeling. What makes you own a particular asset, a non-income producing asset class?
So for example, I'll use Bitcoin as an example. I ran some tests a few years ago, I think it was like 2018, 2019, of like the optimal portfolio. So I ran a portfolio optimizer. It puts a bunch of asset classes, it mixes them up and says, what's the highest return per unit risk portfolio? And that portfolio came back with like US stocks, US bonds, and Bitcoin. Those were the three things. And Bitcoin was 2%, right? So obviously I'm not just owning three asset classes. I own more than that. I'm even more diversified than that. But I was like, 2% sounds about right. And I've kept my Bitcoin allocation between 2 and 4%. And so over time, as it shot up a lot in price, I've sold some down. As it's come down, I've had to buy more. So right now, I haven't had to sell in many years because my portfolio and its growth have kind of kept up overall. So like it's still in that 2 to 4% range, and I just leave it there. Obviously, if it were to collapse a lot, I would buy more of it. But it's about figuring out kind of what how that plays out. But I do think like that's an example. Same with gold, like having a few percentage points in gold, that's up to you. I think we've seen a run up in gold recently, and who knows if that's going to, once again, this thing goes through fits and spurts. It'll go up a ton and then it'll be flat, or basically, just tread water for decades, right? And so it's one of those things where, I don't know what's going to happen, but I own just a few percentage points and that's it. And some of that's physical, like I actually physically own it on me, and some of that is in like an ETF, like, or of some sort.
But gold, at least we have like a lot of history. But with crypto, for example, we have like 15 years of history. How can you trust the data?
Yeah, no, that's a fair point. I mean, we have centuries, or I'm sorry, millennia with the value of gold, and it's hard to acquire, and that's why it's valuable, because you can't just make it in a lab out of nowhere, right? Their alchemy, as much as has been tried, has not, succeeded, which is good. Right? It's actually funny, people don't know this, but aluminum used to be more valuable than gold at one point. The top of the, in the United States, the Washington Monument, which is the big pillar with a little pyramid at the top, that used to be tipped with aluminum, because at the time it was the most valuable metal in the world. And then they found all these processes to extract it, because it's obviously very abundant in the Earth's crust and everything. So as soon as they made it, basically overnight it became, now it's a can we drink out of, right? It's like it's very cheap.
I heard this story a couple of times. I would love to know more, like to have somebody telling me, I don't know, maybe some wealthy person at some point decided to go all in with aluminum and then discovered that it's worthless. It's like if tomorrow we will discover how to mine comets, and then we discover it's full of gold, so gold is no more that scarce. It's interesting. I think probably the post of Dollars and Data, your post that I cited the most in my videos, in my live, is the one where you explain why you should not pick individual stocks. And recently you wrote an update on the third reason, but I love the second reason. Can you tell me why you should not pick individual stocks?
Yeah, so I'll explain the first reason quickly, because I'm assuming your audience probably heard of it. But the first reason, which has been thrown around for a long time, is like, you're unlikely to beat the market averages, right? You picking stocks over a 5-year period, most active managers, professionals who are paid to do this, can't beat the market. It's like 80% of them can't beat it after fees. So 80% underperform, something like that. And you can look up these reports. There's something called SPIVA, S-P-I-V-A. If you search that, you can see different markets, different countries, all this stuff, what percentage of managers outperform the index. And it's a small percentage, especially over long periods of time. That's called the performance argument. Like, you can't outperform, right? The second argument, which is what I call the existential argument, is like, how do you know if you're any good at this? I think that's probably the argument that was bigger for me, which is like, okay, and the analogy I give is if you give me and LeBron James a basketball and we go out on the court and you didn't know who LeBron James was, but you understood, but you understood basketball as a game, right? We would play, and within a minute you would know, okay, this guy's better than me, right? Just because he has better technique, all these little things, you can see his skill, right? The thing is, if you give me and LeBron James hey, we have to pick stocks, you're not going to know who's better for years, and there's luck. It's like, I'm not going to by chance just get lucky and make 50 3-pointers in a row. It's not going to happen by luck. Maybe I can make 1 in a row, maybe I can make 5 in a row, but the skill versus luck is very small in basketball. It's almost all skill. When it comes to investing, I'm not saying that there's no skill at all. There's definitely skill, but how much luck's involved, especially over short periods of time, is actually quite large, right? And so my argument to those who are stock picking is like, okay, let's say you think you can outperform. Let's put that aside. How do you know if you're any good? And if you go through a down period, even the best investors who actually are skilled, legitimately skilled, went through periods of negative performance, underperformance, right? So even if you're skilled in one period, maybe your skills don't apply to the next period, right? And vice versa. So I think there's a lot of head games you have to play to be a stock picker, if you're being honest. And you have to really believe like, oh yeah, I can still do this. I'm still good. And you don't know. And that's the hard part. Like, my job is,
passing and you are investing time in this.
Yeah, and that's another piece of it which I can get into as well. But I think the existential one's the biggest one. Like, when I'm a data scientist, right? So when I have to do stuff for work, like, I'm told, hey, can you summarize this data? It's not just going to by chance summarize itself. I know I have to write some code, I have to summarize it in some way, and then it comes out. And then I look at it and so, does this make sense? Then I present the results, right? So that's not going to happen by chance. I know my work product is real, and I have to actually, add value to make this happen. When it comes to stock picking, I don't have that same feeling. Some people might, but I don't, because it's hard to know what's going to happen. You have to wait possibly 3, 5, 10 years before you have any real data on how good you are at this as well.
Because it's too noisy. There are too much noise. The signal is scarce. And so, And then the third reason, the last change.
The third reason is kind of the mental freedom, which is I don't spend time on it, so I can spend that time on something else. And so I think there's a lot of people who spend a considerable amount of time working on this thing, and I think, and that's not true of everyone, but I think many of them would be better suited using that time somewhere else where they have a known strength, where they know for sure they're adding value and they can double down on that. For example, if I could go back in time to 2017 and I could spend all my time researching stocks, or I could spend all my time writing blog posts, which is what I did, right? Like, in which iteration of the world am I better off? I could almost guarantee 99 times out of 100, I'm better off in the world where I just focus on writing. In terms of my financial success, my happiness, all these other factors, like focusing on writing has been a bigger payoff for me.
Opportunity cost is like very high, of course. Well, you have an idea what's the status of like financial industry, but I don't want to say financial advisory industry in Italy, for at least, but in general in Europe. Italy is probably one of the worst, where they will still try to sell you the idea that they're active fund manager. They will, of course, beat the market. They are smart. They are smarter than just a passive ETF. And they will charge you 2%. How does the industry, the financial advisory industry in the US work? There are still plenty of companies who try to sell you the idea that very high fee funds, or you're doing something different. I mean, not just you at Retail Sweat. I know your philosophy, but in general, the industry is healthier, or
I think so I think we're a little beyond that, because that used to be how we were, like probably 20, 30 years ago. Like, that was, especially in the 70s, that was the industry, was all mutual funds and commissions and things like that, load commissions. And so my understanding, at least, of how Italy's market works is a lot of these, like, there's commissions and fees just baked into the product, and that's how the advisor is compensated. So you don't see here's an advisory fee every quarter that comes out. There's no pain of like, I had to pay $500 or $1,000 or whatever it is. It's just it's slowly taken out of the NAV, so you don't notice it, right? But you'd only notice it is if you had two accounts, both invested in, let's say, a U.S. stock fund, just to make it simple. One's with the advisor, one's not. And over time, it's like, well, why did this one grow to more? It's like, because they're not taking a 2% fee every day. And so Here's my counter to those people. It's like, even if let's assume that those people are telling the truth and actually are skilled and they can beat the market. The question is, can they beat the market above their fee? That's really the
Yes.
hurdle. The hurdle isn't just beating the market. Like, well, I beat the market by 1% every year. Great. But if you're charging me 2%, I'm worse off. Like, you see the problem? Like,
Well,
it's like,
they can change the benchmark. They can say, oh, look at this quality ETF. They beat look at this quality mutual fund. They beat the standard market cap weighted. Well, of course, quality factor in the last few years overperformed, but it's really hard. I'm running like battles every day to try to debunk all the myth. What are the role of a financial advisor? What's the role? And everybody should have one, or how does it work in US, or at least at Retail Wealth Management?
So not everyone should have one. It's going to be based on a few things. First, it's like, how complex is your financial life? If your life is very simple, very easy, if you don't have a lot of assets, you just, like for someone in the US, let's say you just have a W-2, aka 9 to 5 normal job, and maybe you have a 401k, like there's not much we're going to be able to do for you, especially if like you're just starting out or something. Now, if you're like, well, I have a few $1 million and I've been working for my whole career and I have kids and I have a marriage and I want to set up a trust, like the more things, the more complex it is, the more value we can add. And especially as the dollars get bigger, the bigger the mistakes are, right? All else equal, $100,000 portfolio and $1 million portfolio, then when someone makes the mistake on the $1 million portfolio, it's 10 times larger, right? So the value of an advisor adds goes up and up, which is why, in the United States, we focus on the high net worth, 1 million, US dollars plus market, because it just, the value is so much more obvious, right? And we can take this to the extreme. Imagine a billionaire client that just made a small mistake on like 0.5% on their portfolio because they didn't invest their cash or something. Who knows what it is, right? Something small like that, the value add is obvious, right? So you can see in the extremes it makes sense, right? But it's just kind of where that marginal dollar is. So in terms of the US, like where to think about this, I think one is just, yes, the financial complexity, but two, personality actually matters a lot as well. And so there's a guy named Michael Kitces in the United States who looked at research on this, and he found that you can roughly divide people into 3 different groups. There's the people that want to do everything themselves. They might listen to your show. They spend a lot of time. They will never work well with an advisor because they always want to do it themselves. That's fine. So let's take that third and let's kind of exclude them. There's another third which want to delegate. They like, I don't want to deal with it. You do it for me. I don't get this stuff. Or maybe they get it, but they still want, like, I want a professional, like, with their hands on the wheel, I want them controlling it. So that's a third of people, right? They are great for financial advisors because they need that. They need that certainty. They need someone else to run that for them, right? Just like how I would hire a lawyer because I'm not an expert with legal stuff, someone's going to hire a financial advisor for the same reason, right? And then the third group is kind of the more interesting group because they want to do it themselves, but they also want a second opinion of some sorts. They want someone to just kind of look over it quickly and kind of stamp of approval. They don't need an ongoing relationship where they're paying fees consistently, but they do need something where someone's checking their work. And so that's usually better for like a temporary relationship or a maybe hourly where you're, hey, I only pay for the time I need from you. That's usually better for those people. So just based on personalities and what we found in the data, like, my target market as a financial advisor or for my firm is that 1/3 of people that are just trying to delegate. Like, hey, I don't want to deal with this. We're going after that slice, right? The other 2/3, we can't even serve them because our model doesn't fit their needs. And that's the truth. So ask yourself, hey, am I the right person that would eventually delegate this? And you can change over time. You might be a do-it-yourselfer for a long time, and at some point you're like, this is getting too complex. I have too much wealth. I'm making too many mistakes. I need an advisor now. And then you're going to move into one of the other camps. So I think over time it can change as well, but it's something to keep in mind.
Makes sense. Thanks. Yeah, I wish there would be a market or like an industry more well-suited for those who just seek validation. Because I think maybe one day when financial education will be more widespread, and given the fact that we have like a lot of very cheap tools, and it's not that hard to invest on your own if your financial situation is not very complex, maybe an industry for those who seek just validation, like hourly billing or something like this. Maybe that's something that could happen.
Yeah, we need to solve that. It's a difficult problem. People try to do it with robo-advisors and stuff, and I don't know if it's been perfectly solved, to be honest. I
read an amazing article about from Josh Brown about why robo-advisor never took off, and also your partnership with Betterment, I think. No?
Yeah, and it's been great for us, but I agree. It's not like it's gone up, 50x since we started it. Like it's gone up, and we've had more clients come on, and some clients love
And
that,
it's
but it is very
increasing,
different.
and it's very cheap. I mean, I think the lift off project, it's like 50
Yep.
basis point.
Yep.
I mean,
Exactly.
in Italy would get nothing. You get both a robo advisor and something on top. I mean, that's amazing. Yeah. Anyway, so let's back to investing. How do you define risk? What are the risks associated with investing?
I think there's two types of risks. I call it short risk and long risk, or short risk or slow risk and fast risk. There's different ways of thinking about it. And most people define risk, which is what I call fast risk, which is like, could I lose money tomorrow if I, invest in this thing? Like, I think slow risk is also one of those risks that people overlook, which is, once again, bringing back to this like commission model or 2% model where you own a fund, and every day you're just paying pennies and you're losing money. Just like inflation. Inflation is a slow risk, right? The same thing is true of fees, right? Nothing, no, you're not going to just wake up and your fee is going to take 50% of your account. And that's not like, what could happen if the market drops. But it's one of these slow things that slowly over time gets you, right? And I think the analogy with drugs is like, cigarettes are a slow risk, right? It's not something that kills you right away. You can smoke one cigarette and you'll be fine, right? But you do it for a long period of time and it develops into different things, right? But compare that to a fast risk, like, for example, in the United States, we'd say heroin or some very extreme drug, right? That's something where you could do it once, and if you do too much, you can overdose very quickly and die, right? So those are the different types of risks.
The equivalent of heroin in investing, and the equivalent of cigarettes.
Yeah, cigarettes, exactly. And so when I think about risk, there's the most important thing at the end of the day when it comes to risk, and how I define risk, just the simplest way, is like, if you need to spend money and you can't. That is all risk boils down to. Like, oh, I need to spend money to buy something and I can't spend it because my money is either illiquid, or I don't have enough of it, or I'm borrowed too much. Like, there's a lot of ways this can happen, but like at the fundamental level, that's it. That's what the risk is. When someone's like, oh, what's the risk of like in retirement? It's, oh, I need to spend money to survive. Like, I'm retired now, I don't have any income coming in, or maybe I have just a little bit of income, but I can't do that. That's where risk comes in. That's where you're like, oh wow, I can't
Not
spend the
being
money.
able to meet your financial needs.
Yeah, you can't make your financial needs. I can't pay my mortgage. I can't do that. At the end of the day, that's what it comes down to. If you can make those, then the risk matters a little bit less. Of course, there's other types of risk. Oh, there's a risk that I can't live out my highest dreams or whatever. That's one thing, but that's less important than like, I literally can't spend money on something that's an immediate need.
I find not many people talk about this. For example, just sometimes something that just comes to my mind. If my goal is to live the rest of my life with $100,000 per year, and I have 1 million, I need to take a lot of risk. But if I have 1 billion, I could be advised, just put your money under your mattress. You don't even have to take risk. So nobody talks about this. People focus on, if you have this amount of wealth, you should invest this way, and never based on what are your actual goals. That's something that I find there is room for a lot of talk in this field.
No, I agree. I think that's completely true in terms of, people say, oh, you need a portfolio of this based on your age or that. It's like, it's not just your age matters, but the other thing that matters is how much actual wealth do you have? I mean, the larger your balance, the more it changes the risk-taking behaviors you could take, right? In different ways. And there's different ways to debate these risk-taking behaviors, right? Like, someone would be like, well, the more money you have, the more risk you can take. Well, in theory, that's true. But at the same time, you may want to start taking less risk as you start to build more wealth, because you need it protected. So there's a kind of a mixture of emotions and different things that come into this decision.
Yes, we can enter some of the territories where me and you, we can disagree, or at least I've found some weird loophole in all the things you posted here and there. So you said on LinkedIn a few days ago that typical investors try to maximize their returns, smart investors try to minimize their stress. That's something that I really love. Another post, not from you, but from another guy who I love, it's called return on sleeplessness. So what's your return divided by the number of sleepless nights you've spent on? But then at the same time, I don't know, you argue against dollar cost averaging, which is another way to sleep well at night, or other, like sometimes you talk about pure optimization, and sometimes you have these posts about how can I say, the emotional aspects or the behavioral aspects of finance. How can you reconcile this?
I think it depends the extent. Even when I talk about dollar cost averaging, which just, by the way, there's two definitions of dollar cost averaging, which makes this even more confusing. I'm quite confident the one you're talking about is like, okay, let's say you have a bunch of money and let's say you have $100,000. You can either invest it now or you can do, let's say, $10,000 a month for 10 months, right? Those are your decisions, right? The truth is, like, the shorter the period that you can dollar cost average in, the less it matters. And I don't really care. Like, even 10 months is kind of small. And on average, you're going to maybe underperform by 4%. If you're okay giving up that 4%, do it. Like, don't put it all now. Take 10 months to do it. I think the issue I see, and I've seen clients do this even where we've talked with them about this, they say, okay, I have this $100,000. I want to put it in over the next 5 years. Now, the underperformance is quite significant. And it's to the point where I'm like, that is too much. That's too long of a period. And so I try and say, okay, I'm going to put half of it now and then average in over the next 6 months, the other half. I'll put 50K now and then, like, let's say, I don't know, 12,500 over the next, 6 months or whatever it is. Or actually, it's less than that, 8,500. You get my point, yeah.
Can you imagine what could, from an emotional point of view, from a guy, maybe it's like 50 years old and he inherited like 10 millions, and then you think, okay, just go all in. And then the night after, there's a market crash.
Yeah, no, I'm telling you, that's the most extreme example where someone got all of their wealth in one time. That's very rarely the case. If that is the case, yes, you're going to probably average in, or you're going to just put it into a more conservative portfolio. Like, that's the other thing. You should never be like, if you have, this is my life savings, let me put 100% into like US stocks, for example. That I would never recommend that under any circumstance, right? So it's like, okay, you probably should put a few $1 million in like treasuries or something safe that's going to pay you an income that can take care of your basics for the rest of your life, and then you have some other money to play with.
Dollar cost average into a more riskier portfolio.
Yeah. So trust me, I'm not against doing. I'm not like, you can't do it, it's stupid. I never say that. I'm just saying, like, these are the trade-offs, right? Here's what you have to, and I recommend people go all in, but at the same time, like, what is the cost of that, right? And so showing that and saying maybe you just need to go all in on a less risky portfolio. That's my biggest recommendation, because you can just be done with it. The other thing, too, is like the shorter the time window, the less it matters. We're sitting here, some people even, I get these requests like, should I, I want to put my money into my IRA. Like, should I do it all in the first, 3 months of the year, or should I just do it every month? I'm like, it doesn't really matter. Yes, the first 3 months help slightly put that money in, but once again, in the grand scheme of your financial life, this decision does not matter. And I think
something recurring by nature. So
in the extremes, it matters. Like, yes, $10 million is all you ever have. Like, but then again, like, that person's gonna be fine. The $10 million are gonna be fine one way or another, right? So that's my counter, is like, at the extremes it can matter, but for most people it doesn't. Like, just do something that you enjoy and go. I want to show people the data. Like, hey, like, you don't need to worry so much when you invest your money, because most likely, especially if it's in like equities, it's going to go up over time on average.
You also, there's something which we are, of course, aligned, that you should not try to buy the dip, of course, not try to time the market. I think those are the two things that I've seen you talk the most. So try not to buy the dip, try to not hold on your cash just to wait for a better time, because maybe dollar cost average in that situation is a kind of market timing. But we agree. Let's not try to buy the dip. I know all the history, all the data about that. But there is another thing that I struggle with. Do you accept or advise or whatnot that an investor might change their asset allocation based on market circumstances? Let's say just, I don't know, multiples or market valuation. So the larger question is, Schiller, for example, he found correlation between the inverse price to earning and 10-year rolling returns. So do you think that makes sense to change your asset allocation based on base rates, on future expected returns? That's something I struggle with personally. Sometimes I do change. I also, now that Vanguard say that maybe we should do 30-70, the tactical aspects of your asset allocation.
Yeah, this is
more general. Do you think there is a kind of life cycle investing, or your allocation should be something which is not connected to where you're at life and what's the condition in the market?
Yeah, so there's two different questions there. The first question is more general. Let's ignore life cycle. Let's just say for the same person, same spot in life. Like, I think I have difficulty with this as well, because there is this tension between, okay, things are looking a little extreme, like we're at the 99th percentile of all these indicators, like maybe I should change things a little versus pure market timing. And so I think there's this is a spectrum, right? There's like, oh, the P&E is too high, I'm going to go 100% to cash. Never, ever would I recommend that. There's basically no circumstance where I'd recommend that. At the other end of the spectrum is like, okay, no matter what happens, I'm just going to buy, right? And I'm closer to that, but I'm not that far. I do think what Cliff Aston says, you should sin a little, which is like, I'm a little off of that. I don't think there's no situation, but I think what you do is I go from, let's say I had, 100, let's say in my retirement accounts, I had 100% in risk assets. So that's equities, real estate, etc. I even did this recently. I moved that to 80% risk assets, and I added a bond allocation in case there's ever a crash. Because, right now Vanguard is saying we should have a 30-70 portfolio, 30% stocks, 70% bonds. Like, I think that's crazy too. But like, I think they are directionally probably more right than being 100-0, U.S. stocks, 0 bonds, right? I think that's way crazier than 70-30, but where is that right mix? I don't know, right? And so that's kind of the difficulty. So I agree. I don't think people should be market timers, but I don't think you should do this a lot. You should only do this in very extreme circumstances. And I think today U.S. stocks are in one of those similar circumstances. We just saw this happen in 2021, and I know there's a difference today, but it feels like kind of there's like rhymes going, like there's a rhyming of history, and I'm like, this feels a little weird. So I just move minor tweaks, and that's enough behaviorally for me to move past it. But also, it doesn't really jeopardize. If I happen to end up being wrong and the market keeps going up, great, I'm still fine. If it crashes, that's not great for anyone. But like, I did something to make a difference, and that's kind of the tactical thing. And my firm does that too. We have a tactical model we use for about 20% of clients' their assets. We have a tactical model that's either all in on an equity portfolio, or it goes and it shifts. So 20% of your assets are going to be shifting in and out of equities, right, over time. And so I think that is kind of, we have research on that. We've seen how clients react to it. Sure. Yeah, that works. So that's the first piece. Just sorry, there's a longer answer. Yep. Second question, which is, well, what about life cycle? I think life cycle actually matters more. That thing is more important than the first thing, which is, what are markets doing? It's like, where are you in your life? Oh, I have a family, or I'm going to have more kids, and something like that. You probably need to be a little bit even more conservative than someone who's younger, has lower liabilities, has a more of a time horizon. Like, I think there's kind of this weird, where like, you take a lot of risk in your 20s, you have to kind of lower that risk maybe in your 30s and 40s, especially if you have family formation. And then later, once you're in your 50s or 60s, you can actually ratchet the risk up a little bit more. So there's this weird, like, kind of lowering. Yeah. So I think it drops more, and then it comes back up a little. I don't know if it goes back to where it was in your 20s, but I could see this kind of like high risk, kind of like medium risk, and then medium high, if that's like your risk tolerance. And then, or if you're already like medium, then you go to low, then you go to like, low medium, right? that's how I see risk. Now, it's not the traditional models say, oh no, your risk should just go from high and then just slowly go down over time. I think there needs to be this, especially with families that can't help for them. Once you have adult children, you don't need to support them, hopefully, as much as when they were actual children, where you have to support them. So I think that's the big change that happens.
Yeah, but another argument is that, the market returns over your lifetime, that we have history, even though, we have like 150 years of history. And if you are 90 years old today, you covered most of the history. But the impact of those returns, they matter a lot of when they happen, no? So yes. If you are a normal person, regular person who started earning money at 20 something until 60, and then start declining, the last 10 years before retirement is where damages or happiness happens. Just money-wise. So it doesn't matter if in your first 10 years the market has a boom. So one of the arguments is that to even out a bit, to have the years of your investing weight almost the same. You should go even leverage at the beginning, and then go very conservative when you are at your peak, which is probably close to retirement. And then the older you get, maybe the money comes down, and then you can deleverage a bit. That's a concept I am really fascinated about, but there's not much talking about this. So I think this is something that it's really worth a future book.
Well, there is a book I think it's called Life Cycle Investing, which talked about this. I read this in
Is the Scott Sederberg study? Which one?
I think it's called Life Cycle Investing, if I remember. Yeah.
It's by Wade Pfau, Michael Kitches, the guys who
it's by Ian Aries and Barry Nailbuff. Life cycle investing. Yeah, no, there is a book on this. I read this a long time ago, and it's not a bad book. I think it's a very economist view of the world. Like, oh, you're rational. You should borrow a lot early. And like, if everything works out great, that's fine. But I imagine the person who starts their career in 2000, starts heavy leverage, gets, cut in half in the first. So now like everything they're saving, they're like, what the heck? Then like, okay, I'm going to keep following this because I'm still young. They do it again into '08. Of course, this is, I'm cherry picking a bit here, but you could imagine someone learns the wrong lesson, which is investing is not the thing to do. And then they just hold cash from 2010 onward and they miss all the upside. And of course, someone could get that even in a non-leveraged portfolio, right? That could happen as well. But I think it's like, it's one of those things where like most of the time it works and it's a good strategy. It's a question of how much leverage and to what extent. I think the devil's in the details here. And, it would have worked for me if when I graduated in 2012, it would have worked great.
I remember
if
it was your post or somebody else that says that essentially when the decade you were born changes a lot your view on the markets. Like there are people who were born or when they started investing. So you're saying that even if you want to average out more like the early years and the late years, maybe if you may risk of getting burnt quicker and then changing your views on investing and blah blah blah. Do you take as a mantra the fact that the stock market will keep going up for the next 1,000 years, or sometimes do you challenge that? Or maybe the last 150 years, 200 years have been like a weird blip in human being, and then we will revert to a flatter future, even though maybe even in the other direction. I mean, in 1 billion years, the Earth will be destroyed. So at one point. For the Rolle theorem, there should be some local maximum.
Well, yeah, no, of course, there's going to be at some point, but we're getting into like these much bigger questions, like, well, what if there's a nuclear war? Or what if there's another pandemic? Like
they seem very close.
Yeah, if we invest based on that, we would never invest at all, right? That's the truth. Like if you really want to worry about those existential threats, you'd never invest ever, right? Or you'd maybe invest a lot less than you probably do. And so I think it's a question of like, it's not going to matter. Your stock portfolio is going to be the least of your worries in any of these scenarios, so I don't worry about those. I think in terms of the market going up, I think there is going to be, I think technological progress will continue. I think there will be some real return. How large that is and to what extent is unknowable, right? But I do think there will be actual progress made. There will be profits made around the world. And the question is, will they be publicly accessible, I think is the bigger question, right? Is there a world where maybe AI becomes so powerful that people just launch their own private companies, they never have to go public and they make enough money, and so people are kind of kept out of that. We're in this nice world today where because of, passive investing, indexing, and public markets, like people IPO and then they're a part of the system, and then everyone free rides the passive investors. But the people free ride off that, which is good. And so the question is like, is that going to continue, or is Wall Street and companies and business just going to be like, you know what, we actually don't need to. Why should I go that route? I should just not help these people, and I'm going to just make my private company and get rich on my own. And so I think that's more of the issue than is there going to be progress and will there be profits and growth and all this? I think that's pretty much going to happen, barring one of these big catastrophes. The question more is the public going to be able to benefit from it like it would have since, the index funds invention, since the beginning of Vanguard in the 70s and stuff. So is the last 50 years of great returns for retail investors going to continue in the next 50? I don't know. I think the world as a whole is going to keep progressing, but whether retail investors can get it is a different question.
That could undermine the concept of passive investing for the next 50 years. That's a very good point. I will think about that. Let's say 3 pages of questions. We will never. Let's move to the wealth ladder. So you defined the base 10 buckets. So from Can you explain a little bit what's the rationale behind, and what are those buckets?
Yeah, so these buckets, there's 6 levels. This is the book, right? And there's 6 levels. I have these $6 bills on here to show that. But the first level, and this is all in US dollars, was less than $10,000 in net worth. That represents about 20% of US households, okay? The next bucket was $10,000 to $100,000 in net worth. That's another 20% of US households. The third bucket was $100,000 to $1 million in net worth. That's about 40% of U.S. households. The fourth bucket, or level 4, is $1 million to $10 million in wealth. That's about 18% of U.S. households. Then there's $10 million to $100 million. That's a little less than 2% of U.S. households, and then there's 100 million plus, which is like very, very small percentage. Like there's only 10,000 of those households in the United States. And why do I use a 10x? Because it's easy to remember. The data fits it quite well. As you can see, it's spread out. It's not like just like all the households are in one thing. Even though these are quite large ranges, the households are actually spread out amongst them quite well. It's only the last two that are it's only the top 2%, but there is a long tail of wealth. That's just true of any society, any capitalist society. So I came up with this because I was looking at the data and I was like, oh, wow, this fits nicely. And it fits with a lot of the economic classes in the United States and kind of how people live. I do think people in level 3 live a little bit differently than people in level 4. People in level 2 live differently than people in level 3, etc. Obviously, age is one of the most important things here. A lot of people in level 2 and level 3 are just younger and haven't had enough time to get into level 4, etc. So I think that's another piece of this as well. It's not just, okay, well, if your wealth is this is your level. It's like you may just need time to get into those other levels. And so from this framework, as I was talking about earlier, depending on which level you're in, you might follow a different strategy, right? If you're like, oh, I want to get to level 5, that's very different than, oh, I want to get to level 3, right? Let's say you're in level 2 today. The strategy you follow would be very different, right? And I talk about this and I show data that supports these arguments.
Where did you find all the data? Because you usually mention data. Do you have some database or statistics or something?
Yeah, so there's two data sets I use. One is called the Survey of Consumer Finances. It's run by the U.S. Federal Reserve, and that has like a snapshot of wealth data at a given point in time. So this is 2022 to 2023. So I looked at that data. But then there's also another data set called the it's from the University of Michigan. Wait, I'm kind of blanking on the name of it right now.
I assume it's more fine-grained.
Hang on one second here. We're going to edit this out.
I don't know if you are sharp in 5 minutes or you have more time.
No, I can stay a little bit longer. Give me 1 second.
So I also questions about fire that I want to ask.
Yeah, okay, we can talk about that. Yeah. I'm sorry. So the second data set is called the Panel Study of Income Dynamics from the University of Michigan. And that data looks at the same households over time, right? The Survey of Consumer Finances is doing snapshots of just everyone, but it's using different people, so I can't follow the same people. The Panel Study of Income Dynamics lets me follow the same household. So then I can say, oh, what's the probability of you being in this wealth level today? And then a decade from now, how many of those households moved up a level, went down a level, et cetera. So that's what made it very useful. And I summarize that in chapter 10, all the kind of mobility stuff. And I think it's useful as a framework because it's just a different way of thinking about wealth. And it's the analogy I give in the introduction is like a fitness instructor would give different advice to someone who's morbidly obese versus someone who's a well-trained athlete. I think you can use that same analogy to think about financial decisions, right? Like you're going to give different advice to someone who's trying to get to level 5 than someone who's trying to get to level 3, right? And so just thinking through that. And I also talk about some of the downsides of trying to get to level 5, level 6. It's, some people say, well, doesn't everyone want to just get to level 6? So I'm like, well, maybe, but maybe not. And so like, let's look at the data, what it shows in terms of the sacrifice, the downsides of wealth, and that people don't talk about. I know it's like a very weird, first world problems, very privileged.
Hey, but I see that on LinkedIn you are talking a bit about money and happiness. Just scratching the surface, I assume, between money and happiness. Maybe that's a good direction in the future. Have you found that those in the same bucket have similar problems? I assume so, or else it's not just a matter of...
Yeah, in general, that's usually the issue. For example, those and they're not just similar problems, they also have assets. They have similar asset profiles in terms of what they own, right? So those in levels 1 to 3, on average, less than 25% of their assets are income producing, right? But those in levels 4 to 6, over half of their assets are income producing. Yeah, this post here is this actually comes from my publisher. This is talking about how I think this applies to spending. And so what this is showing is in each level, there's different spending freedoms. And there's a rule I use for this. So level 2 is what I call grocery freedom. So when you go to the grocery store in the United States, you can kind of buy what you want by the end of that level. Level 3 is restaurant freedom. Level 4 is travel freedom and so forth. And I explain kind of where this comes from in the book a bit more.
You know what? I'm old enough and I follow you enough that I remember the post in 2019. Yes, and it was one of the first I complained a lot about this. You saw you probably throw a rule of 10,000, 0.01%.
Yeah.
And I remember complaining because this is something you do every day. You can, I understand. The complaint I have essentially is that okay, so something that costs 1 basis point of my wealth should something I should not care about unless I do 5 times per day. So
Yeah.
I cannot have coffee freedom if I take 5 coffees per day. I can
Yeah.
have vacation freedom because I do once per year. If it's 0.1%, 0.001% of my wealth, who cares?
Hmm.
How do you? I think that I read on some more recent posts that you mentioned the total spending per year. That makes sense more than single episodes.
Yeah, so I think you're right. The timing matters, right? If you can't just say, "Oh, I'm going to do this 100 times a day." In the extremes, the argument falls apart. I see that. I think it's more. This is assumed to be a daily measure that you could use. I'm not saying you should use it daily. I don't actually recommend that at all. I'm just saying it's supposed to be a daily thing. Like, oh, I go to the grocery store. Okay, maybe I do that. I can upgrade to the slightly nicer thing. And as you get deeper into that level, this becomes more true, right? So as you're deep into level 2, by the time you're almost in level 3, it doesn't really matter as much, how much you're spending at the grocery store, right? And this kind of goes on.
I'm at a level 4, but I still care about pennies. I see there is a
Yeah.
trend, not just in you. I also seen Morgan Housel new book, or even Ben Carson is writing a bit about this. That retirees, they don't spend enough money, blah blah blah. It says there is a push of trying to make people spend more. Those who cannot spend more. My counter argument is that I still love to not spend a lot, even though I could, even though I should be grocery free. But I get a lot of joy just knowing that I could spend more, but I don't. That's peace of mind. That's peace of mind. Do you think it's a sickness or
I
not?
don't know if it's a sickness. I do think there's a personality trait there. There's something possibly going on. I'm not saying it's wrong. I mean, everyone, you have the freedom to spend it's your money. It's not mine. I don't control your purse. I don't control your wallet, whatever. Like, it's none of my business. I'm just saying everyone can spend how they want. We're just saying, hey, look, the data shows like you guys can probably spend a bit more. Retirees aren't spending enough. There's people who are obsessing over these things. Maybe not obsessing. Maybe you don't obsess over it, but like, oh, I don't want to spend on that. Fine. It's up to you. It's really up to you. And the argument, I think the big argument that was put forth was die with zero. Bill Perkins, his whole argument, which not everyone agrees with, but he's like, you spend all this time, energy, work so hard to save all this. This is life energy you've saved. You put your time and your effort into getting this money. Why aren't you willing to spend more of it? Like, you dying with a bigger.
Why should we assume that I make sacrifices to save money so that I can consume more in the future? Maybe a person did for just more peace of mind, or saving is good on its own sometimes.
No, yeah, we're not anti-saving. Trust me, I'm not the person that's anti-saving. I'm just saying there's extremes to this argument. Like, I'm not. That's why I don't agree completely with die with zero. I think it's directionally better than what I see, and I think it's also different in Europe than in the United States. Like, in the United States, I'm like, oh, you have to be level 4 to like have financial freedom. I think you can do that at a lower wealth level in Europe because the services are better, and more in particular, the healthcare is not as much of a problem, I think, right?
Well, I live in Switzerland. Maybe
Yeah.
Switzerland is like US, so level 4 is not enough, sadly.
Yeah.
And actually, first of all, I think die with zero is gonna be the new Kiyosaki, and I'm not sure I like that. I'm not sure it's gonna be something positive, but it's way better. I mean, way better, but on the same kind of. It's gonna have a cult-like following, but. I want to say, I will ask you to rehearse for the nth time that thing you've done in a couple of other podcasts or interviews, of what brings to level 4 cannot bring to level 5.
Yes.
Please do.
So the idea is, what got you here won't get you there. And the main thinking is like, the way to get into level 4 is not necessarily easy, but it's relatively straightforward. Like, the strategy to get there, it's like, okay, you have to have a good job, you have to have a decent income, you got to save money, you have to invest over time. And if you do that for enough decades, probably 2 to 3 decades for sure, you'll very likely get into level 4, right? Especially if the income's high enough.
Millionaire.
Yeah. 1 to 10 million, right? Somewhere in that range, right? That's generally what the data shows. You can follow that, you can get there. Now, to get to level 5 beyond 10 million, that's basically not going to cut it unless you have a very, very high income or really insane investment returns. Like, you have to have something in the extreme to get there. And the math makes this very easy. So let's just pretend today you have $1 million, right? And let's say you're saving $100,000 a year, which is a lot of money. It's a lot of money, even in the United States, Europe, wherever you are, right? And you're earning 5%, let's say, after inflation. So you're keeping up with inflation, right? So this is all real dollars we're talking about, right? The question is, how long would it take for you to get to 10 million? And the answer is 28 years. So you have to do this for almost, and this is after you got to 1 million. So once again, getting to 1 million is already a difficult in itself. But let's say I just handed you that, like you'd still have to do this for another 28 years before you got to 10 million. So getting into level 5 is just basically not going to happen, or it's going to take an extreme amount of sacrifice and effort for many decades to get there using a traditional job, savings, investing. It's just not going to happen. And so the way there for most people, if you do want to get there, once again, I don't think this is necessary at all. Just for the record, the disclaimer, I don't think it's necessary, and I talk about why in the book. But if you like, I have to get to 10 million, you have to start a business and you have to sell it for a lot of money. That's basically it. There are exceptions like athletes, entertainers, celebrities. Like there are exceptions to this rule, but assume you aren't one of those people, which are even rarer than business owners. You're going to have to start a business. You're going to have to sell it for a lot of money, or at least keep the business and it's worth a lot and it's paying you just like $1 million plus a year in income, where you can make, even after taxes, you're taking home a lot of money, and it makes it very easy to get past 10 million. So those are really the only options.
Makes sense. I mean, it hit me because I'm at level 4 on the on the near side, not on the far side, and I have my job, I have my cash flow, and I just realized that becoming extra wealthy, this is not the way to go. You need to build equity, you need to build something that can scale and you can sell. So we are into the entrepreneurship world, but 10 million is arbitrary, no? Maybe within the 4th level, there is you're enough somewhere. Maybe.
Oh yeah.
For most people, it should be there, unless you live maybe in New York City or in Zurich. Easier enough. So maybe, even though your math is like, it's surprising, I also saw you saying that if you save 300,000 per year, it will still take 17 years. It's crazy. You cannot reach 10 millions by just working, unless you are maybe a director at Google or something. But maybe regular people will have there enough in the millions.
Yeah, that's my counterpoint, which is like, you don't need to get to level 4. I don't think most people need to do that. And you can be financially free if you spend, if you spend $40,000 a year. I mean, some would say, okay, you could probably do that at $2 million, because that's, using the 4% rule, that, that would give you 80,000. So even with, fluctuations, let's say you're now using the 2% rule in theory and you're fine, right? So there's different ways of looking at it. If you need 100,000 a year, okay, how much do you need, right? You can, using the 4% rule that says you need 2.5 million, but what if you're like, I need a 45-year timeline or something, then okay, you might need a bit more than 2.5. You might need 3 or 4 million. So once again, this is debatable and open to interpretation. There's a lot of wiggle room here. I think in general, like, yes, people's enough is much lower than that, but I do think for a lot of people it's somewhere in level 4. And it also depends. If you have a pension or something that is going to pay you, a certain amount of income every year, you can drop your enough number.
The amount you need is always enough that needs to cover the not covered by pension lifestyle. There is one recent post of yours that made me think a lot. It's titled "The Death of the Amex Lounge: Why the Upper Middle Class Isn't Special Anymore." I think it's still related to this topic, so I will ask you. I can see 2 conflicting thoughts on my mind about this. Is the middle class dead or crowded? Because in general, what's your take on wealth inequality? And I'm not interested in politics here now. I just, do you think it's rising? Do you think it's an alarming level? I'm just interested in what the data say.
I definitely think wealth inequality is rising, but I also, there's also more wealth being built. So like the upper middle class and the middle class is getting more crowded in many ways. So there is kind of this bifurcation going on where there's more people like kind of moving up across the spectrum. So that's generally true. There's like less poverty, at least in the United States. But because it's getting more crowded, it's also kind of changing the experience, right? Like the Amex Lounge used to be this super nice, like you go in there, and it's not that it's bad. It's not bad at all, but it's just like, now there's like a huge line to get in that never used to be the case. You go in there, there's lines for everything you have to get to. Like, it's just getting overcrowded because there's a lot more people with money. I mean, there's a lot of people that are doing well enough where they can now do this. There's a lot of people traveling. Like, there's more people traveling than ever before. There's people seeing the world. Like, because of this, it's just becoming one of these things where there's a higher competition for the same number of scarce resources, and that's just creating a lot of this. Like you can go to like one of the nicest resorts. The story I tell in that blog post, I was at a nice resort in the Bahamas, and at 7 a.m. there are people on their vacation who are spending hundreds of dollars a night to stay there, right? And they're out there running to the pool to grab a chair at 7 a.m. They're waking up early, setting alarms to go on their vacation when they should be sleeping in, enjoying their life. They got to go get a pool chair, because if they don't get a pool chair, their experience is ruined. And because there's not enough pool chairs, right? There's not enough space for all the people in the hotel.
The grind happens also on vacation. I mean, you need to have the right mindset to get the chair.
Yeah, wow. I mean, well, that's the thing. Like, if you have that chill mindset, you go there, and then there's nowhere for you to sit. So then you're like, what the heck? What did I pay for? Like, it becomes, that's where it's really kind of rough, and that's where I think we're starting to see some of these things happen, unfortunately.
I have just a couple of more questions. If you have time, a couple of more questions.
Yeah, of course.
So, one about spending and one about fire. One about spending. You sometimes say cut spending was one of the misconception, not the way to get rich, and we just discussed about this. But you also said on LinkedIn once that there are two ways to feel healthier: have more money or want less. One takes years of hard work and sacrifice. The other is a mindset shift. Choose wisely. Which one is which? I thought they were an inside joke. So
no, it's a question, because it really is true that, like, yes, if you want less and you spend less, like, of course, that's a much simpler way to go to get to some level of enough, but it's not easy to do that, right? Like, people like enjoying consuming things. They like going out to dinner, or they like traveling, all these different things, right? They like living in a nice place, like, etc. So because of that, there is this tension, and I explore it. Like, of course, like, in general, I don't think, cutting spending is the way to build wealth. But once again, building wealth is very different than, feeling like you have enough. Those are different things.
Okay,
right?
So maybe this is the actual, like, the real point. I mean,
Yeah.
wealth and feeling rich is different. So of course you will not become 10 millionaire, but maybe you will learn that having 2 millions is enough if you cut your spend.
Something like that. And so I think it's just like, there's a lot of, it's interesting the more I've like studied personal finance and written about it, there's a lot of these weird kind of like contradictions in the literature. Even in the investing literature, it's very true, where someone's like, you want to let your winners run, right? You've heard this before, right? Cut your losses, let your winners run, right? You've heard that. But then there's also like, you have to, so that's one piece. And but then cut your losses early. Like, well, sometimes the winners go down 50%, they go down 50% and they come back, like Amazon, Tesla, like you can name any big stock has been cut in half at least once, usually, at least one time for some random.
You get cut in half and never recover.
Yeah. And some never recover. So it's like, how is it like I'm supposed to let my winners run? I'm supposed to cut my losses. What if one of the losses I cut was eventually going to be my winner, right? You see my problem? Like, it's like there's so many contradictions out there. And if you sit and look through all the advice, like they all say kind of conflicting things, right? So it's just like, it's very specific. Like in this specific scenario, this works. And in this scenario, this works. But just keep that in mind when we talk about a lot of these things. Because like really a little change in context and the thing makes no sense anymore.
You have also been critical about FIRE several times. One of the, I saved some of your LinkedIn thoughts. One just said that if you build a life you will never want to retire from, that's the way to go. What's your take on FIRE in general?
I have nothing against him personally. I think there's certain FIRE is a very broad movement, and so to just say something on FIRE, I don't think is that useful, because there's so many different things. For example, I love something called coast FIRE, which is the idea that, okay, you save up enough so that your future retirement spending is taken care of, and then you can kind of maybe shift gears and change your career. I love that. I'm in love with coast FIRE, right? That's a part of the FIRE movement, right? That's one subsect. Then there's like lean FIRE, or something where like, hey, and then there's like, I want to get to the point of FIRE, the traditional FIRE, which is like, I just need to have enough money where I never have to work again. And I don't necessarily agree with that. I think that you kick the bar up and you don't really gain as much from that. I think it's better to like have a lower bar so you can get to your FIRE earlier, but it's more of a coast FIRE type thing where you still need to work, you still need to save some money, etc. Maybe you don't need to save as much, or you don't need to save anything. You just need to cover your current expenses, and then your retirement's taken care of. But I'm more open to that type of FIRE than the one that's like, you have to cut everything, don't spend any money, don't go out, like don't have fun
But
with your
it's
friends.
also a
Like,
misconception.
yeah,
The
yeah.
actual fire, I mean, the founder there's no founder of fire movement, but the
Mm-hmm.
people who started fire movement or started talking about this, that you probably know. I saw you also partnered with the mad scientist at one point. It was
Yeah,
amazing.
yeah.
Uh, the, the goal is not to do a lot of sacrifices. It's to learn how to be happy with less, essentially.
Mm-hmm.
Learn that you don't need fancy cars, you don't need a lot of things. So you're not like sacrificing and doing something that hurts just to stop working and then discover that keep living at that level of expenses and is not suitable for the long term. So that's for me, it's not the real fire. The real fire is that you find, it's actually an inner search. You find what's your enough, and you should be fine with what you find, and then aim to cover that needs. The complaint I have with this own definition is that you don't know yourself. You don't know what happened in 10 years, 20 years. You might have kids. You might. I mean, I reached my number. I doubled my number of 10 years ago. It's just I'm a different person. I have 3 kids now. I live in Switzerland and I like Switzerland. So I was planning to maybe move back to Italy without kids. Now I have 3 kids in Switzerland. So my number went up. So that's my complaint with fire, is that you don't know what life is gonna be in a few years. But you mentioned you've been a couple of times on LinkedIn probably mentioning that the alternatives, like you should build a life that you don't want to retire from. That's pretty tough. I mean, there are a lot of variables. No, maybe you change career and you do something that you like more, but then at one point you are 50 and then that career is it's no more a career because the job got automated or you got sick or something changed. How to edge against all those risks? So for
I
me,
mean,
fire is like aiming to some sort of financial independence is inevitable. You cannot not do it, or else you are at the mercy of when the government decides that you should stop working.
yeah, no, I see your point. I mean, this is, once again, I think this is a marginal argument. And what I mean by that is like even financial independence is making some assumptions about the world, like asset prices. For example, let's say we went through a Great Depression. I can guarantee you that 90% of the fire bloggers would no longer be financially independent, right? If we went, let's run those exact returns again.
Technically, the
Yes.
4% rule or whatever safe withdrawal rate you accept, because if whatever you listen to, they have different numbers. I love bigger early retirement now numbers. I think it's more precise. If you take 3.27%, then you should have survived also the Great Depression if you kept spending that amount adjusted for inflation.
No.
Yeah, of course. That's the theory.
I agree with you. Like I know what the numbers say, but I'm telling you, if we go through a Great Depression, they are not going to feel like they are financially independent in the same way, right? So there's a lot of, we have these assumptions, we run these back tests, and of course, this is marginal. Like at some extreme, even financial independence can fall apart. I'm not saying that that's going to be the case, but yeah. So it's like, okay, well, like, this is like, okay, coast fire isn't as financially independent as just traditional fire. I agree with you. Like, would it be better to have even more, to have more layers of redundancy? Of course it would be, right? You can't control everything. It's a question of like, well, that requires you to get to a higher level before you can be there. And so it's a question of like, if you're doing a job, let's say you don't love, but you're like, I'm doing it for the money because I need to get to this point. This is the trade-off you have to make. You have to do that thing you don't love, so you have more redundancy here. Or you can say, hey, I'd rather do something I love, and I'm going to have a little bit more risk in my career. And so these are it's all just a trade-off, right? That's all what we're talking about. And if you don't want to make that trade-off, that's fine. And maybe I am willing to make it. I think we want to lay the options out for people and let them choose the risks they want to take, right? And so I think that's when I think through this, when I'm thinking through fire, like what are the risks you want to take? And some people are like, yeah, I'm going to not have a car. I'm going to bike everywhere or walk. I'm just going to, my hobby's going to be hiking. I'm going to live in a super low cost of living area, and I can just retire as soon as I want. If that's what you want, great. There's nothing against that. I don't know if I want that. So I'm kind of against that, but I don't think it's not right for everybody, right? So I think it's just, what are the trade-offs associated with these lifestyles and understanding those risks that you're taking in each different type of fire. So that's kind of, I've only been against it because I've been like, I'd rather you just find something you love. And I think that, of course, is there risk there? Could it get automated? Of course it could. But I'd rather you at least enjoy that period a little bit more and deal with the risks and the consequences later than, put yourself through trudgery, your whole life just doing something you don't want to do just for money. I don't know. I don't feel like it's enough in my opinion. So
thank you, Nick. It's been a pleasure. For those who are listening or watching, just keep buying in Italian version, mr.rip/Nick or mr.rip/Maggiulli for the wealth ladder. You will find a link on Amazon and whatnot. Thank you so much, Nick.
Thank you so much.
An honor for me. I'm a huge fan of yours. And yes, thank you so much.
I appreciate it. Thank you for having me on, Giorgio.